the United States federal government borrowed $11 trillion. And just to make sure they had plenty borrowed, they did what I call the Inflation Creation Act and borrowed another $1 trillion. And that's to subsidize green businesses and ESG initiatives that all those companies are losing money. I call ESG extra stupid growth. That's what I call it. And I started calling that 2 or 3 years ago when everybody thought it was a great idea. So they're funding with federal government borrowed money, extra stupid growth that can't be anything but inflationary.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter and your host for this conversation today. And I'm really looking forward to it because this is with a first-time guest here on the program. It's Bill Smead. He's the CIO and lead portfolio manager over at Smead Capital. He's a recurring guest over on CNBC as well. Like you can see him almost weekly there, giving market commentary on what is happening in the markets. And I'm looking forward to having a really in-depth discussion with him as well. I warned him a bit. I'm going to quiz him a bit on what the housing market in the US looks like, because for me, that is an interesting indicator of what is happening in the economy overall. And it seems like the housing market is anticipating rate cuts in the US as well. Really curious what kind of picture he will draw for us there as well. But before I switch over to my guest, quick reminder, hit that subscribe button. Let us know how we're doing. Do you like the questions that we ask of our guests? And is this educational and informational for you as well? We really do want to hear from you because we're not doing this just for fun. We do want to educate and provide some really valuable information to you. Now, without much further ado, let me bring my guest on the screen here. Bill Smead, it is great to have you on the program. Thank you so much for making the time.
Thanks for having us.
Oh, absolutely. No, really looking forward to this and watched quite a few of your interviews over on CNBC, of course, as well, and really value your opinion there, Bill. Let's start setting the scene a little bit, and let's start talking about the state of the economy. Really curious. Bill, set the scene for us. How is the economy doing right now?
Well, we have been what you would call economic optimists for a number of years. And the reason is because in the United States, we have very favorable demographics. There's 330 million people in the United States, and 180 million of them are 40 and under. And as opposed to prior generations, I calculate that adulthood starts at about 28 in the United States now. It used to start at 21 or 22. So we have a relatively young, best days ahead of them group of people with much more financially secure and wealthy parents. And those two things added together make a pretty darn good economy.
No, interesting, Bill. Like, what makes the parents so wealthy? I'm curious. I think we need to drill down on that. Where's that wealth coming from? I think that is an interesting discussion to be had. Let's break that down. Where's that wealth coming from? It can't just be government handouts, of course.
It's funny you asked that question because just a couple of days ago, I was digging into the Federal Reserve Z1 report of the mixture of financial assets or assets owned by U.S. households in aggregate. And in 1982, 9% of household assets were directly and indirectly in common stock. And today it's 40%. So basically, I'm 65, about to turn 66. My group has watched the stock market in 1982 go up unbelievably, immensely over 40 years, while interest rates went down until a couple of years ago immensely, and therefore created a bunch of wealthy people over the age of 60.
Wow. Okay. Of course, like we're looking at the stock market today, we're in a massive melt-up phase as well, of course. But as you said, bonds have been declining for 40 years pretty much, right? So there is a massive wealth effect there happening. And of course, real estate has been revalued a gazillion times as well. I don't have the exact number, of course, since then. But that is an interesting tidbit. Let's turn that around, though. So how vulnerable is that generation as well when the market starts maybe turning around? Because as I said, we're in this melt-up phase right now. A lot of euphoria in the stock market in particular. And 40% is a really high number there, Bill. Like, how vulnerable is that generation?
Well, it's extremely vulnerable to a decline in net worth. Most people live out of their income, but certain things live out of high net worth. And that has been on display constantly for the last 10 years. The latest today, Jeff Bezos just bought his third, $70 million home in Florida, as an example. And that exemplifies basically what people do that have way more money than they know what to do with. And that's what'll go by the wayside, by the way. That is what will, that'll get tapered. Most of your normal spending things won't get tapered. The incomes of the people over 60 in the United States will not change dramatically by what the stock market does, but the willingness to spend on frivolous and massive things will be retarded by that.
Let's talk about the consumer. How is the consumer doing in the U.S.? So it's like, it seems like there's a very bifurcated picture, amongst the consumer as well. Like, it doesn't seem like everybody's doing great. I just heard yesterday that restaurants and occupation of restaurants is declining. It's pretty much at COVID levels almost.
Well, the restaurant thing is very interesting because the average American gets their reading on inflation at the gas pump, right? They go every week to 2 weeks to fill up their tank. And if they see the price has gone up, they're worried about inflation. If they see the price go down, they're not worried, even though what you spend on gasoline in the United States is probably half as a part of family budgets what it was 20 or 30 years ago, right? So it's bizarre. It matters less, but it's in your face. Therefore, that's the psychological tool for measuring inflation. Whereas if you go to your favorite restaurant or fast food place, the prices have skyrocketed, and you're not really tracking it compared to the last time you were there. So the irony is California just took minimum wage to $20. So imagine what that's going to do to restaurant employment. It's just, it boggles my mind. So we are in an inflation era. We are in an inflation era that's going to dominate what you want to do with your investments. There's too many people with too much money left over from the $11 trillion of monetized debt that was created to fight the COVID war, chasing too few goods. And that is the single most important factor in what you should do with your money, in our opinion.
No, absolutely. And I agree with that. I was just in the US last week as well. And all I saw at fast food stations were tablets where I could order, right? So there is that substitution effect, of course, happening. Increases in productivity, I think, is another topic we should talk about as well. Maybe before we jump to the inflation discussion here, does that actually help? Does advancement in technology, and I'm hinting at AI here, will help increase productivity and maybe boost unemployment?
Well, I don't want to get too far away from my own pay grade, right? I have a bachelor's degree in economics and 43, bordering on 44 years experience in the investment markets, but I'm not a sophisticated economist by training. So let me go back, repeat the question now that I gave you that caveat.
No, it's just, does AI and boosts in productivity potentially through technological advancements, will that, what are the ramifications, more or less?
You're bringing me into one of my favorite subjects. So let's just think about AI for the moment, right? There's been an explosion of stock prices that benefit from the adoption of AI. So we looked back and asked the question, what do explosions based on the adoption of new technology do in the stock market? And what we found did not surprise us. It's what we expected to find. So in 1927, well, actually 1923, 1% of American households had a radio. By 1931, 50% did. And by 1937, 75% did. So in 1927 and 1929, the largest producer of radios, one of the two largest broadcasting corporations in radio, national broadcasters, and one of the two largest content providers to radio, RCA, went from 10 to 110 in 2 years in anticipation that radio would change our lives. Did radio change our lives? Yes. It ended up being one of the most prosperous industries in the history of the United States of America. From 10 to 110 in 2 years, the stock went to a single digit for years in the 30s. And as late as 1945, you could invest in RCA. And then the next 20 years after that, you made a ton of money. But the history is that after that explosion, it's always different this time, but it always rhymes. Meaning that after that spectacular burst, be it Cisco in 1999 or Disney in 71, 72, you always get disappointment because you're right about the future. AI will be very important, and you always lose way more money when you're right on something that gets euphoric than when you're wrong.
Absolutely. We're seeing that right now. NVIDIA is leading the charts, obviously. And as you said, all the stocks that have AI in the name have been doing really, really well, or even companies that provide data to AI companies like Reddit has really, I haven't looked at the recent Reddit chart, by the way, but just when it IPO'd that day, it rallied, what was it, 50% or so? It was,
all the symptoms. You've got all the symptoms. My favorite one is the McGonaghy commercial. If AI is the new West, then data is the new gold. Ka-ching, ka-ching, ka-ching. I mean, that is a short seller's dream right there. And by the way, it matches the 2021 late advertisement dream. The lady that gets in the ice bucket on the QQQ commercial. I mean, you could get rich shorting that, the QQQ on that commercial. And I think you're going to get rich shorting AI over the next 4 or 5 years.
Oh, absolutely. As you said, booms and busts are very close to each other as well. So we'll talk about like timing of that current melt up phase as well, because not everybody is participating. It's very small amount of stocks that is rallying pretty much. So it comes back down to like how healthy is the economy? Like how healthy is the underlying economy? We've got lots of data dumped on us again in the last 24 hours of recording. Recording on April 2nd here, by the way. We had US PMI, we had job report come in as well. So how close are we to a meltdown? Like, you know, like how close are we?
Well, I think this is the most like the 60s and 70s as the analogy, the rhyme that rhymes the most. So we borrowed an incredible amount of money in the United States federal government to have 500,000 American troops in Vietnam, and did Johnson's Great Society legislation expanding federal government welfare the most since the Depression in the late 60s. And then you had a ton of baby boomers, the largest population group to ever go through the pig and the python. And you had too much money in the hands of too many people chasing too few goods. So we had that. We also had the space race in the 60s and the go-go 60s. I mean, think of it. We got all the same thing. It's Musk and Bezos doing the space race. It was the federal government back then, but it's still, the rhymes are just crazy good, right? So that's the time period. So to understand that, you go to a Fortune magazine article in November of 1999 to get a repeat of the talk that Buffett did to the Allen and Company Summit in the summer of 1999. And this is what he told the newly found .com billionaires. From 1964 to 1981, the United States economy grew 4.3% on average. And the stock market went nowhere. The primary moniker back then was the Dow Jones Industrial Average, because the S&P 500 had not been popularized yet. So the Dow got stuck at 1,000 at the high for 17 years. The stock market went nowhere for 17 years while the economy grew 4.3% a year. That's what we're going to go through. That we think that's what we're going to go through. We think the economy will grow and stocks will do poorly because it's a overcooked goose.
No, definitely. It seems like it. We're in this melt-up phase right now, but we're getting fantastic economic data. Or fantastic, maybe a bit of a stretch, but solid economic data, if you want to believe what's coming out of the official, whatever the official numbers are here. It is looking quite rosy. I've been asking guests as well, like, is the U.S. actually getting away with one here? Meaning getting away without actually a recession?
It's pretty likely that we'll have one. Again, part of it would be if the stock market turns sour, that's going to take the edge off of spending. Back in 2008, when things were just terrible, we did a deep dive into the U.S. economy. 80% of what goes on in the U.S. economy happens every year. It's fixed things like health insurance and things that just happen automatically. The growth or decline in the economy comes out of the 20% that's variable. And so that's what could get hurt. The 20% spending that's variable, it could be impacted by what the stock market does. And so if the Fed keeps credit tight and we go into a substantial bear market, which probably will be the first of maybe 3 major bear markets in the next 10 years, it will impact the economy. And that would ultimately lay the groundwork for the Fed to lower short-term interest rates, but probably not till then. They're just playing with fire and seeking to make the mistakes of the 70s.
Which they're desperately trying to avoid, but it seems like they're running into the same issues yet again, which they seemingly can't avoid because they're using old data, right? So they're not using current data as well. So they'll always be behind the 8 ball here.
Well, I'm always amazed. Back in the brick trade era from 99 to 2012, we were laughing at people. 70-plus-year-old Ivy League educated Chinese men were pulling the strings. They were the puppeteers of the Chinese economy. And Americans were completely convinced that everything they did was going to be right. The Federal Reserve Board is 7 men and women that are educated in Ivy League colleges pulling the puppet strings on the United States monetary policy. And for some reason, we think they're going to have better outcomes than the 7 people in China that were educated the same way. And the answer is history says that's a bad bet. That's a really bad bet, because that's, treating a fiscal problem, right? The $11 trillion of monetized debt was created fiscally. With monetary policy is like asking your brain surgeon to cure your cancer. He's a great doctor. He's a brilliant person, but they're not cancer experts.
Absolutely. No, I fully get that analogy. It makes a lot of sense there, Bill. We need to talk about inflation. And you brought up gas or the gas price into the discussion as well. And I mentioned to you before hitting the record button, we need to talk about the effects of the oil price on inflation moving forward, because there is a bit of a lag effect until the oil price sort of hits the markets and hits the economy. So I'm curious, how does that rising oil price, and we're about $84 a barrel right now, sort of factor into your inflation estimates?
Well, let me first preface this. Back in 2020, we were provided a chart by Barry Bannister out of Stifel Nicholas, and it showed that commodities in dollars were the cheapest relative to common stocks and had the worst performance relative to common stock for 220 years. Now, in Europe, 220 years isn't as long as it is in the United States. It's everything in the United States. So, in effect, we began a mean reversion trade in the late spring of 2020, where oil and gas being the lead commodity, the addictive legal drug in commodities, starting probably a 10 to 15 year bull market relative to stocks and on an absolute basis. So therefore, you first have a big move in commodities, and then over time, you change the psychology to a deflationary psychology, which we had for many years, to an inflation zeitgeist, which is what we ended up with at the end of the brick trade in 2011 and what we ended up with in 1981 at the end of the inflationary 70s. So we're in a process of going from no one thinking inflation will be a problem to everyone thinking inflation will be a problem by the end of another 7 or 8 years.
Yeah, it doesn't look like the inflation beast has been fully tamed. We have rising PCE numbers, and core inflation is up, and it is sticky. Do you see that? Like, has the Fed even the power to change that, to reverse that, or are they just treading water here?
No, they don't. Think about it this way: the United States federal government borrowed $11 trillion. And just to make sure they had plenty borrowed, they did what I call the Inflation Creation Act and borrowed another $1 trillion. And that's to subsidize green businesses and ESG initiatives that all those companies are losing money. I call ESG extra stupid growth. That's what I call it. And I started calling that 2 or 3 years ago when everybody thought it was a great idea. So they're funding with federal government borrowed money, extra stupid growth that can't be anything but inflationary. For example, in my state, they're giving $10 billion to people like Intel to put chip plants in Arizona, okay, to onshore chip supplies in inflationary. But when you go from globalization leads to deflation, deglobalization leads to inflation. So there we go. So again, there's no way around it. Inflation is going to be a problem. You could either raise taxes, which would retard the economy. You can't cut spending, but you should cut spending on a federal government basis to pay back the money. But that virtually never happens. And then the third way you do it is to inflate your way out of the problem. If inflation runs 7% for the next 10 years, you're paying back the current debt at 50 cents on the dollar in the 10th year. And that's how governments pay back debt, is with cheaper dollars.
Well, that's not sustainable though. 7% inflation, like even that is not really cutting it, right? Like when it was 8%, I thought it was. I read somewhere like you need 40 years to inflate away the debt problem, right?
You try to inflate it, but it ultimately won't work. It's a disease that dies hard. So what we did in the late 70s and early 80s is we took on 2 deep recessions and I sold an 18% 90-day T-bill as a young stockbroker in 1981 to somebody.
18%.
18%. That's what it took to kill the inflationary 70s. And the president of the United States standing up to a powerful labor union, the air traffic controllers, and saying, if you walk off the job, we'll hire new ones. And those 2 things changed the psychology.
Well, we're seeing that in Europe right now as well. Like, people are walking out left and right, demanding higher wages. And as you mentioned, California, $20 minimum wage as well. So wage inflation and wage growth is accelerating to a degree, which is also a symptom of a very wealthy economy. It's that what do you call it? Like, it's one of those first world problems. It's sort of marking the top as well. Is when you increase wages to astronomical levels. That's a sign of a top as well. Would you agree with that?
Well, yeah, it is a symptom, and it becomes an unvirtuous circle. So back in 1998, Greg Maffei was the chief financial officer of Microsoft, and I was 40 years in Seattle. So he came and spoke to our Rotary Club. I was part of, at one time, the largest Rotary Club in the world, downtown Seattle. And he came and spoke, and he told us about the virtuous circle at Microsoft. The virtuous circle was they paid lower salaries to smart tech college graduates with equity compensation as a lure, options. And because of that, they were more profitable than most tech companies because of how low a salaries they could get away with paying them, which caused their profitability to be high, which caused their stock to do well. And I added in, which caused the S&P 500 to do well because of companies like it being such big factors in the S&P, so that they could hire talented people, so they could pay them lower salaries, so they could give them more equity compensation. It was a virtuous circle. Well, when the inflation bogey hits, you start the unvirtuous circle, right? People demand more wages, which is going to hurt profits, which is going to hurt stocks, which is going to hurt the S&P, which is going to cause people to sell the S&P, which was going to cause stocks to do worse, which is going to cause people to require more cash compensation in exchange for equity compensation. And we're about to enter that unvirtuous circle, and it will be the most intense in technology, where people accept lower salaries to try to get rich in 5 years, which has always been a bad idea in the first place. I mean, who knows anybody that it does them any good to get rich at age 27? That was a bad idea right from the get-go. It's just not a good idea. Get rich when you're 55, when you might possibly be able to handle it.
Oh, absolutely. When you actually have some financial education behind you as well there. Absolutely. Interesting question. Didn't expect a conversation to take this turn, but how does out of like work from home sort of factor into that as well? Because now if you work from home, you're somewhat replaceable by anybody on the planet, right? So
well,
how does that factor in?
Yes, but also, being antisocial, mental health. I mean, there's just a whole bunch of things that get mixed into that. It's just my observation is that if you don't get together with the people you work with regularly, it can't be a positive. It just can't be a positive. So some of it is good, and some of it is very unhealthy. And look, the social media and the technology has created a virtual world where people really don't have to spend much time being civilized. And it is tearing at the fiber of our democracy. And this is not investment opinion. This is my own personal opinion. The way that the technology use and the social media use has developed is exactly what John Sherman was trying to stay away from when he helped drive the Sherman Antitrust Act, which said one of the things that could ruin the United States of America would be the concentration of capital in vast corporations or vast entities. In other words, that's the kind of thing that could divide America, which is too much of the success of the economy going to too few people. And that's why they stopped John D. Rockefeller. That's why they sued IBM. That's why they sued Microsoft. And that's why they're coming after the rest of these guys, because that is bad for the fabric of society.
Oh, absolutely. And I think that's why Google and others are under attack as well, to split up again, because they're just too big, right?
Well, that's why they changed their names. In the United States, somebody that's got a criminal record, they changed their name. It's an alias. We call those the alias companies, because they didn't wait to get convicted of a crime to change their name. They just went ahead and went to the alias before they got convicted.
Or they're just redomiciled somewhere as well. I've seen that too. So it just happens. Let's talk about Fed rate cut symbolism a bit as well. And what does it mean? Like what could potential ramifications be of that as well? And do you even expect rate cuts in the current environment, Bill? I'm curious what your thoughts are on that.
I don't expect, we as a company don't expect rate cuts until real significant cracks start to show in the economy. And the cracks haven't shown. It's going to be really interesting to watch when the cracks come and when they start to cut rates and stocks are falling at the same time that they're cutting rates. Because the first reaction people think is, oh, they're cutting rates, this is going to be great for stocks. And there isn't anybody left to buy, right? The U.S. households now own 5 times as much common stock as they did at the bottom. There's a kind of, you start bumping up to physical limitations. You can't live in a common stock certificate and you can't eat a common stock certificate. So therefore there are limits. And so it's going to be a very entertaining 3 or 4 years coming up.
Yeah, absolutely. Absolutely. It's got to be quite rocky and volatile. I'm just curious, maybe we can work this out a tad more. Like, what does it symbolize when the Fed actually, even if it's a symbolic 25 basis point cut, like really said, okay, we're cutting now. Like, what did they see, or what are they seeing? And B, what will the market take away from that, and how will the market overreact to it, as it always does, by the way?
Well, we think that will be part way through a bear market. And what happens when you get in a bear market and momentum's on the downside, people ignore that. Go back and look at '08. The Fed cut rates quite a bit in '08, and the stock market didn't bottom until March of '09. Because what happens is at the top, when they're raising rates, everybody ignores it because happy days are here again. And then when you get in a deep bear market and they cut rates, everybody assumes that the rate cuts aren't going to work. I can remember being on Larry Kudlow's show on CNBC back in 2010. He'd have me on all the time because I was the only green shoot guy besides him. You know, we believed that the Federal Reserve's rate cuts were going to cause a recovery in the economy. And the economy was lousy relative to most recoveries from '09 to say '13 because the largest adult group, the 20 somethings, were no factor, right? They didn't get married, they didn't buy houses, they didn't have children. So we had this economy that had to be dominated just by the existing consumption of everybody. And so we grew, they called it the most anemic recovery from a deep recession in history. And now those people that weren't forming households, weren't getting married, weren't having kids, they're now going to do that. And so they will believe in the next bear market that the Fed rate cuts won't matter. Market down.
Interesting. Like, I think it's a good segue to the housing market. And I mentioned that in my intro. I really want to talk with you about the housing market because it's a big factor. It's a big part of the US economy, obviously. And it seems like the housing market is anticipating rate cuts already. And prices are not really coming down anymore, especially in like highly sought after areas. They never came down at all, I think. And only undesirable locations dropped again. But like, how do you rate the housing market in general? Like, and what's going into the housing market? Is that a leading indicator, a lagging indicator? And will they be the biggest beneficiary from potential Fed rate cuts?
Now, let me put two things together for you that you've talked about earlier in our conversation and put it together with this particular question. The remote work makes moving to very much outlying areas makes sense as Americans are forced to arbitrage land values. We own U-Haul. I keep telling U-Haul to go to Southwest Airlines and buy their slogan from them. You're now free to move about the country. So let me give you an example. My buddy's daughter got married in September or October in Yakima, Washington. And we own Horton and Lennar, the home builders. And I'm driving into Yakima, and there's a big sign for Horton, new homes starting at $350,000. Now that's $150,000 less than the average of what it costs to buy a home in the United States right now. Yakima is a beautiful place. It's got 4 distinct seasons, a cold traditional winter, but beautiful springs and beautiful falls. There's a sign outside the town. It says the Palm Springs of Washington because they have a hot, dry summer. It's an agricultural mecca, right? There's a ton of fruit and other stuff that's produced in the Yakima Valley. It's incredibly fertile. You got the mountains nearby that blew up once upon a time, and the Columbia River is 45 minutes away. So it's just incredibly fertile, very attractive, and you could buy a house for $350,000. Now that's an area of about 40,000 people that could easily be 150,000 people. 2 hours from the airport in Seattle, an hour from the ski slopes, etc. Okay, that's what the millennials and the Gen Zs are going to do. As they more and more work remotely, they are going to move to where they can afford the housing. And there are 75% of the land mass in the United States is uninhabited. So it's like we're 220 years old. You know, where's everybody going to live when we're 400 years old? Well, it's probably not going to be near downtown Los Angeles.
Probably a good call not to be downtown Los Angeles anyway these days. So, but Yakima I've been to as well. It's close to the Oregon wine region there as well. So it's a beautiful area, as you said. I get it. And Starlink came to mind as well. Even if you have terrible connectivity, based on, you know, original US cell providers or internet providers, Starlink might actually save you there as well, liberating people moving into RVs, for example. So, and moving around the country.
Yeah, we don't own any motorhome producers, but you know, you're right. You're right. Who knows? We might become a nation like the movie Nomadland, where people just travel around in their RV and then work temporarily for an Amazon warehouse for a while.
Could happen. Could happen. I've met a lot of people at national parks that just worked out of their RV just with a Starlink or the dual 5G network as well. Really, really interesting. So housing market is still going to look great, but it's going to be more diversified, right?
Yeah,
so
it's going to be good off and on for about 10 years because the baby boomers were taught by COVID to stay in their house till they die. So the baby boomers aren't moving out. Therefore, the natural supply of existing homes is not going to come on stream. And then the people that did buy a house when the mortgage rates were microscopic are going to have a heck of a time justifying giving up a 2.5% to 3.5% mortgage to take on a 7% mortgage.
No, 7% still. Like, I was just having a conversation with somebody up here in Vancouver, and banks are trying to push people into lower yield or lower mortgage rates over 3 years instead of the 1 year higher ones, because they all see them coming down and they want to lock in that's still higher 3 year as well, because they all anticipate lower interest rates. So
yeah,
really interesting.
It's quite interesting. You got the federal government's got to borrow a lot of money, but yet, and that's how you get the inflation. They'll cut rates even though it runs the risk of reigniting the inflation.
Bill, I believe we just laid fantastic groundwork and foundation of like where's the economy, where your mindset is right now. So the question is, how are you investing? How are you allocating capital? And I'm stealing, you know, a line from, I think, one of your newsletters or the website is highest annual returns from the least amount of risk. So the question is, where are you seeking that right now? How are you playing the markets right now, Bill?
Yeah, 3.5% of the profits of the S&P is invested in oil and gas stocks, and it produces 8% of the profits. So until they get to be 8% of the S&P, you'll be in a very attractive position, we think, with oil and gas. The second thing is, as the millennials and Gen Zs move away from the downtown cores as they get older, get married, and have kids, that the suburban real estate becomes very attractive, and owning a home in an inflationary era becomes very attractive. So, but behind oil and gas, we want to play inflation through people owning a home rather than being a renter, and we want to own our suburban malls, because the shopping that does exist has moved from downtown core areas to way out in the suburbs, and our two companies, Simon and Macerich, dominate the suburban mall shopping and premium outlets, which Simon Property owns. So, and then we want to be the banker to the millennials and the Gen Zs who have decided that no matter what, they want to travel more than any set of people under 40 in the history of humanity. So we own American Express because that's the favorite credit card of people that like to travel, and that is the millennials and the Gen Zs. And they even do that after they get married and have kids. They drag their kids all over the place. And then we own Bank America and JP Morgan because that's where, because of their superior mobile technology back 10, 12 years ago, they have the best mobile banking apps, and they have the best control over the deposits and the future liabilities of the millennials and the Gen Zs. And then we want to keep the baby boomers alive for a long time. So we own Amgen and Merck, and I'm kind of partial to that. And then we own Target and Home Depot because once these young people get married and have kids. She goes to Target and he goes on Saturday to Home Depot. So we're vertically integrated on that score. And I covered I think I just covered about 82% of our portfolio.
Oh, fantastic. Yeah, I've taken some notes. I have to follow up on suburban shopping because, I see malls dying everywhere. But personally, I love premium outlets. Big fan. As a European coming to the US, doing the outlet shopping and the experience is fantastic. But
do you say you're in BC?
I'm in Vancouver, yeah.
Yeah, so you go to Tulalip.
I've been there once, yeah, absolutely. Yeah. But anywhere in the US, I go to premium outlets.
To go to that premium outlet at Tulalip, which is about an hour north of Seattle, on a Friday, Saturday, Sunday, all of Vancouver, BC descends on that place. The parking lot's packed, and it's crazy. I have a grandson that his mother is a Tulalip, and I'm joking that my grandson is going to be the chief of the Tulalip tribe as they just rank in money from all those people on the weekend. It's insane. It's wonderful.
Absolutely. It's like the Trader Joe's in Bellingham. Same thing. So.
Yeah. I'm vertically integrated, right? I as a family. Yeah.
You get it all. So fantastic. Awesome. Bill, this was an amazing conversation. I tremendously enjoyed it. I could have extended it to 2 hours easily because there's still so many topics that we haven't touched on, like the bond market, U.S. debt, servicing the debt, and all that. We'll have to do a part 2 of our conversation here, Bill. But in the meantime, where can we find more of your work? I know you put out a newsletter as well. So where can we find it?
Yeah, smeadcap.com and click on Our Advice. We have our Book with Legs podcast. And we have we write all the time. And just put your email address into the slot and you'll get our almost weekly writings. The piece that's coming out tomorrow is called Hit 'em Where They Ain't, which is a baseball reference to one of the first great hitters in Major League Baseball was a guy named Wee Willie Keeler, who would look at where the defenders were standing and then he would hit the ball where no one was standing. Wee Willie Keeler, hit them where they ain't. And that's the way we pick stocks. We want to find meritorious holes in the other portfolio managers' portfolios and fill them up. That all of our resources are available at smeadcap.com.
Fantastic, Bill. I do have one very last question. I apologize. It just came to me because I meant to ask you that earlier when you talked about oil and gas being a bigger part of the S&P 500. The miners. What do you feel about the miners? Like Newmont is part of the S&P, but it's completely underweight. Like it's not a factor, of course, at all. Curious what your thoughts are.
I just read a book about the life of T. Rowe Price, who in the late 60s saw the federal government monetizing this debt and made a big pivot toward natural resources and gold. So I'm using oil and gas, but I don't think people would be foolish to use other commodities and possibly gold, which is kind of a barbarous relic, but it does quite well in inflationary time. But we don't own any gold, so I'm not endorsing it as something we own, but it naturally, anything that hedges against inflation is likely to be a pretty good spot to hang out.
Oh, fantastic. Appreciate that. Thanks for humoring that last question there as well. So really appreciate that, Bill. And thanks so much for your time. It was a great pleasure. And we'll have to get you back on very, very soon. And everybody else, thank you so much for tuning in here to Soar Financially. I hope you found this episode and conversation as informational and educational as I have. If you did, please leave a like, leave a comment. It helps us out tremendously, reaching a wider audience and attracting guests like Bill to the program. And of course, let us know, did we ask the right questions? What else should we have asked? We do want to refine our product. So it's actually really valuable to you as well, the audience, of course. So thank you so much for tuning in. We'll be back with lots more here on the channel. Stay healthy, stay wealthy. Thank you so much.